All right, time for our Fiscal Focus segment brought to you by InfoChoice, your choice of information on Aussie consumer finance. Now, this week, we're joined by Bendigo Bank's chief economist, David Robertson, to get a general update on the state of Australia's economy and, of course, when we might see the next rate cut or rate increase from the RBA. G'day, David. Welcome to the Savings Tip Jar.
Thanks very much, Dom. Great to be with you. Thanks for the invitation to be part of the discussion.
No worries. Glad you're here with us. So there's been a few, in my opinion, like ABS releases that have been at odds with one another. So GDP is pretty weak. Labour force is still strong, although it's loosening slightly. Wages growth has kind of peaked, I would say. But we still have pretty high inflation. So as an economist, can you explain to us how that all sort of blends together and how inflation is still so high?
Yes, it is a perplexing situation. The fact that the economy is clearly slow and slowing, and you mentioned the recent uptick in unemployment, and yet inflation is still uncomfortably high. So it does sound a little bit like stagflation, which is really any central bank's worst nightmare, a situation where the economy is slowing and therefore the central bank would like to add support, but inflation isn't sufficiently low to allow them the luxury of being able to cut rates. Having said that, it's not all doom and gloom. And when we talk about the economy running at a slow pace, at least it's growing. It grew 0.1% in the first quarter, probably going to have grown another 0.2 or 0.3 in Q2. Admittedly, a lot of that's due to population growth. We're in a per capita recession. It's only population growth that's kept us out of recession, along with public spending. But nevertheless, the economy is just growing at the margin. And the unemployment rate, yes, it's rising. It rose from 4.1 to 4.2% in the latest release. But interestingly, that was with still a growing number of people with a job. And so what we're seeing is record high participation rates. And so population growth, more people looking for work, means even as more jobs are added, the unemployment rate is edging higher. And we think it'll move a little bit higher from here. But basically, we've got inflation above target because supply is still outstripping, supply isn't keeping up with demand. So demand is gradually outstripping supply, and demand's still relatively high due to population growth, due to savings accumulated during the pandemic and some of the recent fiscal support measures. Supply is still constrained. We're not building enough new houses. There's a range of offshore factors, conflicts overseas, weather-related disruptions, trade tensions. So, it is difficult. Our main problem our economy has is inflation. Get rid of inflation and the outlook becomes a lot brighter. And that is what we're seeing overseas. That's why other comparable countries like, Canada, Europe, UK, even the Reserve Bank of New Zealand cut rates the other day because inflation's coming down. So it's a case of when that happens for us.
So, I mean, when the whole question of when that's going to happen for us is the debate's quite fierce among economists and other market participants. We've seen some people expecting a rate cut before the end of this year. I think CBA is saying November, but then you've got some people saying there's actually going to be a rate increase potentially in the next few months. Where do you sit at the moment, David? Are you expecting rate cuts or rate hikes in the near term?
We're actually not expecting any move at all from the RBA this calendar year. And I said that back in January, and we were a bit of an outlier back in January, Feb, when we said actually no move from the RBA up or down all year. Back then, we had almost half the market saying that they're going to cut, by spring. And a number of others, and a growing voice during the year that they might need to hike further. They haven't hiked enough. But now the market seems to be joining us in our view that actually they're going to be on hold till the end of the year. We are expecting cuts next year, whether or not the RBA is going to be in a position to cut rates in February. I think that's the earliest they could do it, or whether or not, as I'm leaning to now, it's May 2025. Really what we need to see is that core inflation rate closer to 3%. And at the moment it's 3.9. Now, we will see headline CPI come down pretty quickly from here, including due to the energy rebates and some of the cost of living support that's come through state and federal federal budgets. So headline CPI may well be close to 3% by the end of the year, but not core inflation. And core inflation is best measured by the trim mean and some of the other RBA measures that they look at from the ABS, which we think will be closer to 3% in the first quarter of next year. And if that's right, then whether or not the RBA get to cut in February 25 or May, we think they're the choices. So no, we're not expecting a cut by year end. And yes, there are some forecasters who were or are continuing to talk about a cut in November this year. I could be a little bit sarcastic and say that they were also forecasting cuts last year, but that's another story. But all you can do is run with the data that's at your disposal right now. And for us, core inflation 3.9, they're a long way from cutting. It's a case of how quickly we can get that core rate closer to 3%. And on the hike side, we think it's on a sufficiently benign path that they don't need to hike any further. And again, with the unemployment rate ticking high, we think it'll tick up to 4.5. That would suggest with the RBA, dual mandate, that they need to manage price stability, inflation, but also maintain as many jobs as they can along the way. And so that's why we are of the view that they won't hike any further. And next move down, probably May 25. Fingers crossed they could go a bit earlier than that.
Mortgage holders, I'm sure, are waiting with bated breath to see the first cut, to see some pressure ease in the mortgage space. You kind of mentioned earlier, David, that to reduce headline inflation, the government's throwing a lot of cost of living measures at punters, at households with the energy rebates. State governments are also doing their bit. Up here in Queensland, where we're based, the Stephen Miles government has thrown $1,000 at energy bills, which is good at the individual level. But we sort of saw last week the RBA Governor Michelle Bullock kind of say, and the RBA's forecast saying public demand is going to grow, I think, to 4.5% or something like that. And this is kind of a double-pronged question. How is this impacting the RBA's fight against inflation? And then on top of that, there's programs like the NDIS and other government programs that are perhaps buoying the jobs market. Where do you see this play into the whole inflation conundrum?
There's certainly a school of thought that fiscal policy and monetary policy are working in opposite directions at the moment, or that they're diametrically opposed. We've got tight monetary policy. Cash rate's probably 1% above neutral at the moment at 4.35. Neutral's probably around 3.5. And yet, fiscal policy, to your point, appears to be, if anything, lifting demand. And certainly the stage 3 tax cuts, we were supportive of them. We think they're necessary. We need more tax reform. We need ongoing structural reform, and they are helping to offset bracket creep. But they are putting more money into the households' pockets. But we would say quite necessarily, given the impact of bracket creep, given how difficult it is for households at the moment with the surge in inflation, this is helpful support. Now, when we come to the energy rebates, etc., and not just the federal ones, but state as well, will that simply add to demand and lift inflation, or is that all manageable? And certainly energy prices have been one of the contributors to inflation. So if you look at CPI, the part of CPI that is driven by utilities, that will be helped by these rebates because energy prices will come down. The problem would be if, therefore, you had extra money in the system that was suddenly spent adding to demand. Now, we're of the view that households will actually save that money more so than spend it. And that's a known unknown, but that's our view at the moment. Is it's so tough for households. They'll need this money for the home loan and for non-discretionary, as opposed to using it for discretionary spending. But it's a year where you look around the world. We're not alone on this. I think over half the world's population votes this year, and typically elections come with government spending. Funny that. So we are seeing fiscal support or fiscal stimulus around the world. But again, you look at what's happening in Canada, in the US, in Europe, in the UK, and even in New Zealand, inflation's been coming down despite fiscal support in those areas. And that goes back to, well, what's the underlying cause of inflation? And it's mainly been supply chain disruptions as well as pent-up demand. So that's a long-winded answer to say, yes, fiscal support is probably working against monetary, but all that's doing, I think, is just delaying the first RBA cut rather than preventing it altogether. And then, of course, labour markets, as you mentioned, labour markets have been very tight. Population growth sort of complicates some of these numbers, but what we're gradually seeing is that job vacancies and job advertisements have been falling over the last 6 to 12 months, and that typically occurs as the unemployment, as labour markets start to weaken, and therefore the unemployment rate should start to edge a bit higher. And I think if we get to about a 4.5% unemployment rate, that'll be a rate that isn't adding to inflation. So that's all manageable. But it's a very tight line the RBA are walking, or a narrow path they've described it. Maybe it's a tightrope they're walking. Pick your analogy. They're looking for Goldilocks, and that's still achievable. But we are somewhat dependent on offshore developments, e.g., what happens in the States. Our major trading partner, China, is going through a difficult time at the moment. But they're cutting their rates and adding policy support to help their economy and their property market. So there's a wide range of factors. None of them, though, we would suggest will prevent the RBA from being in a position to cut rates next year.
I mean, on that, mentioning other countries starting to cut their interest rates. We've seen Canada do that. I think the UK as well, China. I just wonder, is that doing some of the RBA's heavy lifting on tackling inflation? Because we know that when other countries have lower cash rates, that means we have a stronger dollar, which increases their buying power and lowers the prices of imported goods. So I wonder, how's that going to factor into when the RBA is going to cut?
Yeah, so it's interesting to see the Aussie dollar a bit firmer over the last few sessions, and it's been really volatile on financial markets, especially a couple of weeks ago when the yen was all over the place, and also when all of a sudden there were concerns about a US recession. Some of those concerns have receded. But looking at other countries cutting rates, as you mentioned, Canada, the UK, a number of the European central banks, RBA, NZ, and we do expect the US to be cutting rates on September 18th, so that's only 4 weeks away. And we're looking for 3 US Federal Reserve cuts in succession, one in September, another in November, another in December. Now, what will that do for the RBA? Yes, if we're right, the RBA are on hold till early next year, then you'd expect the Aussie dollar will be a little bit firmer. That's helpful for inflation in that if you suddenly saw the Aussie dollar plunge, that would add to inflationary pressures. So that's perhaps helpful. I think the RBA would be quite comfortable if the Aussie dollar slowly trended up to around 70 cents, which is our forecast. But, it depends why other central banks are cutting. So, for example, if the Fed were cutting, the US Federal Reserve, if they cut rates in September, but have to go a bit harder because they think they're going into recession, that might have global implications. What we sort of need is a more benign environment where the only reason they're cutting is because inflation's come back down. So I think it depends why they're cutting rates is probably the answer to the question. And, markets a couple of weeks ago suddenly got spooked that, hang on, not only are they going to be cutting rates, but they're going to be doing so because we're going into a recession. Whereas only a fortnight later, here we are today, and we've had 10 sessions in a row where stock markets have gone up. And suddenly markets are factoring in rate cuts, but without the recession. So that's really the fascinating part about where we are today. If you look at previous inflation shocks back in the 70s and 80s, the only way we got rid of them was by central banks taking up rates so high that they induced a recession. So are we actually going to get this Goldilocks scenario this time where, sure, it's tough, but it's not a recession by virtue of the rate hikes, and all of a sudden inflation comes back down and we're back on track. So it's, again, a very fine line, but at least that path is still visible.
There we go, David. Hopefully the RBA can walk that tightrope as you described it. We threw a lot at you and we covered a lot of territory in today's podcast episode, and we thank you for your time on the Savings Tip Jar podcast.
Pleasure. Thanks for having me.
Thanks, David.